You're looking at some serious returns. And there's people out there right now that say that my targets of 85 to 110 are just silly low, right? Michael Oliver says that we could go to 150 to 200 in Q2. Those are numbers that they're mind-boggling. They make your head spin. But that's what we're looking at. That's the kind of, and then we look at the other side of the coin, the bears. The bears think that silver has peaked here. And as my opening comment said, this has nothing to do with silver. This is all about gold and the drivers of gold.
According to Don Durrett, silver's rally has nothing to do with silver itself. It is being driven by gold. Gold is rising due to central bank buying, growing debt, and the weakening dominance of the U.S. economy. As gold strengthens, silver is being pulled up as a monetary metal, while ongoing physical supply deficits and rising investor demand add extra pressure. Short-term pullbacks are normal, but unless the drivers of gold break down, the long-term trend for silver remains bullish. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
First of all, I want to say that this has nothing to do with silver. This is all about gold. And also the S&P 500 to a certain extent, but primarily about gold. So gold is such a large market, so much bigger. Silver is a really tiny market. They have basically they're really different markets, if you will. Gold, that's something that central banks are buying. So gold has been rising for a large extent because of central banks, but not just central banks, but also kind of the smart money. So the smart money's been buying gold. But on a percentage basis, gold is so much larger, and the investor portion of gold is actually pretty small. Is pretty big versus the investor portion of silver. It's kind of the opposite. It's like investors are like 90% of gold and maybe 70% or 30% of silver. Silver basically became a monetary metal in August. Until August, it was mainly treated by investors as a base metal, not so much as a monetary metal. But once it got to once it got to $35 in July, then it just took off in August and went to 40, and now it's knocking on the door of 70. But that is just a catch-up trade. So gold rises for the wrong reasons. If gold is doing well, which it's doing extremely well here at $4,400, I mean, it's up over $1,000 per year the last 2 years. I mean, it's been ripping. So it's up over 100% in 2 years. It's up 60% this year, over that, over 65% now, I think. Silver's up over 100%, 120%. But for gold to be up 100% in 2 years is kind of unthinkable in many respects. In the year 2000, gold was $250. Think about that, $250 in 2000. Well, what happened? What happened in the year 2000? The dot-com bubble burst, and we went into a severe recession. And the S&P 500 really didn't get back on its feet for 12, 13 years. It wasn't too long ago where it was below 25% investors, but now it's kind of jumped up to about 30. So now there isn't a lot of excess silver. As a matter of fact, we've had deficits for the last 3 to 4 years. The above ground silver has, the amount of silver that's mined on an annual basis has not been enough for demand. So we've had to use above ground inventory to offset those deficits. And that has been slowly hollowing out the inventory of silver. We are going to see shortages in silver because it's just a matter of time before the investors want some. When the investors want some. So the investors want 80% of gold supply, And currently they want 30% of silver supply. If investors want 40% of silver supply, you're going to have a shortage. So I've always believed that we're going to see shortages in silver. The thing that's really pushed gold higher, which is the reason why I'm in gold and silver, is the US economy is no longer the juggernaut it once was. And its dependence on debt has gotten worse and worse and worse. And so people are going to gold, foreigners mainly. The US central bank doesn't buy gold. Canada's central bank doesn't buy gold. England's central bank doesn't buy gold, right? Japan's central bank doesn't buy gold. So it's basically our non-allies. It's all of our enemies that are buying gold. And they're shifting away from America. So America, when the Ukraine war started in 22, I think it was in 22, you started to see a bifurcation of the global economy. We talk about the global South. This is really harmful for the US economy because we've been in a dominant position since 1945. We're losing that dominant position. So gold has these unbelievable factors that are holding it up, pushing it higher. And those factors are actually getting better, not worse. Now, silver was highly, highly undervalued. We had a GSR of 120. Now it's down about 65. But I said that, it's going to squeeze down over time. If gold keeps going higher, the reasons that are pushing up gold will eventually pull silver up. So silver is being pulled up as a monetary metal in conjunction with the drivers of gold. So what's pushing up silver is the drivers of gold. That's the main factor. Now, we also have these other factors, but those aren't the main factors. But those other factors kind of push silver up higher, faster. What's the new floor for silver? I had the floor at $45 2 weeks ago. If we close this Friday, and we probably will, above where we're at now, 68, somewhere in there, I will move my floor up to 50. So the floor keeps rising. And as the floor rises, that really helps the silver miners. Because if you have a $50 floor, that's going to create a lot of incentive for silver miners to basically spend more money to get silver out of the ground. And it's going to create a lot of incentive for companies to do acquisitions, to take advantage of these high margins. At $50 silver, the margins are plenty high. We're looking at about 40% margins at $50 silver, somewhere in there. Maybe not quite 40, maybe 35, but those are sufficient to make money. We can expect 2 more years of bull market for gold, silver, and the miners. That's my expectation, 26 and 27. Now, a lot of people think it's going to go on a lot longer than that. I say that in 28, we have to be very, very cautious of this market ending, especially 29 or 30. So basically, the risk starts really ratcheting up in 27, 28, 29. You just have to look historically what silver's done when it basically turns into a monetary metal. So in 2011, which was a very short-lived rip for silver, we went to 49. We didn't stay there very long. And we came back down. Even that short period of getting to 49, we had a GSR of 49. And the SGR, which I kind of like to use that better, you divide silver into gold, because the percentages are easy to do in your head, was 3.5%, which we're not even close to that. We're at a little over 1.5. So if you use 1% of gold, that would be $44 silver. If you use 2%, that would be 88. And so we're not even at 2% yet. And we're going to go I think we're going to go somewhere between 2.5 and 3. And some people would think we're going to go higher than that. But 2.5 is plenty darn high, right? And so I think we're going to, 2% of 5,000 is $100 silver. So that's kind of my target area. I don't know if we'll get there. I think we'll be close, though. We're looking at like $85, $90 is kind of if we look at a range, when gold goes to 5,000, silver will outperform gold. I've always said that nationalization is not going to happen because it's too difficult to nationalize your mines because you're going to lose foreign investment. So the chances of nationalization to me is extremely low in just about every country. But what has high probability is higher taxes, higher royalties, and higher ownership requirements. Now, these aren't nationalizations, but they're kind of quasi-nationalization, is when they demand percent ownership of the mines. They're like, okay, and they've done this in a couple of ways. One of them is they've required local ownership. So a Canadian company goes into a West African country, 10% or 20% of that company has to be owned by locals. Local ownership, not necessarily the government. And then other countries, they have like a free carry for like 10%, sometimes it's the project, not the company. A lot of times it's the project. So you have a 10% free carry to the country. So we're going to see more of those. And those will bite us because depending on which country does. So if a country does it, every single miner that has a mine in that country will probably go down. And if they only have one, if they're a single mine company and they're in that country, they're going to go down substantially. Those examples are all going to happen. Now, as far as gold mining, that's kind of your risk for gold. One of your largest risks for owning gold miners, because your stock, if you pick you're only in 2 or 3 stocks, and one of your stocks gets one of these higher free carries or higher royalties or higher taxes, then your stock's going to get whacked. And so as a gold miner, that's one of your highest risks. Now for silver miners, you actually have a dual risk, which is going to create a lot of volatility. And the dual risk is what you just laid out, or what I just laid out, as far as higher taxes, higher royalties, higher free carries, in tandem with shortages. So if we have shortages in silver, we're not going to have shortages in gold, but if we have shortages in silver, governments and regulatory bodies are going to take action. They're going to take action if you have shortages. They're going to find a way to create more inventory. And there's lots of different methods that they can do to increase inventory. The first one is what they'll do first is what they did in 1980, and they'll basically raise the margins. Like they raised them recently 10%, and they'll just keep bumping them up higher because margins have a huge impact on the players in the futures market. And the future market has a big impact on the price of gold and silver. So if you keep raising those margins, you're going to end up pushing a lot of players out. And pushing a lot of buyers out. Anybody who wants to buy on margin, fewer players are going to buy silver, so that will impact the price of silver going higher. So they're going to mess around with those margin requirements. And at $65 silver, you have 50% margins, which are higher. Those are better than gold miners right now. So gold miners at $2,200. You'd have to have for 50%. You'd have to have $2,200 margins. We're not quite there. We're more like 45%, maybe 48% margins on gold miners average. But gold miners, silver miners right now as we speak are better than gold miners, which is stunning. So the silver miners have higher margins right now than gold miners, which is kind of mind-blowing considering where we were at 6 months ago. One bag's 100% return. You're looking at baggers. So you got to be, that's the kind of, if you're going to get bagger upside, prepare for volatility, prepare for risk, prepare for massive losses. But I will, after that kind of intro for this, I will name the top 5. So the top 5 silver, the only ones that I am dependable on. And I'll mention the 6th one as well, because I think a lot of people like that one. But the first one that I've ranked the highest is core mining. Now, none of these miners mine 80, 90, 100% silver. None of them do. 50% I think First Majestic is about 50% silver. That's about as high as they go. So I look for companies that mine 25% to 50% silver. That's about the best we can get. You just can't find them. Is the first one I've ranked number one is Coeur Mining. So they're about 40% silver. And after the New Gold deal closes, they're going to produce 900,000 ounces of gold and 20 million ounces of silver. The next one, Hecla Mining, they mine 18 million ounces of silver, and I forget how much gold, maybe I'm guessing 150,000. You have about 1 billion ounces sitting in warehouses that are owned by ETFs, spot ETFs, and they could empty all those out. See, the two biggest is SLV and PSLV. Both of those, the G7 controls both of those. So the G7 could basically say, look, we have silver shortages. They need inventory. We got 1 billion ounces here. Let's basically make that inventory and sell those to the fabricators. And so what would happen, there's a few different ways they could do it. But basically, the inventory that they currently have, somebody would have to come up with the cash to pay off everybody that holds the paper, everybody that owns the SLV and PSLV. So we would all get cash, right? And then somebody would be holding a whole bunch of debt and a whole bunch of inventory. So the governments would actually have to step in and loan them out the money. But it's actually not very much. It's actually peanuts. The U.S. government could basically say, okay, here are ETFs, here's the cash. We're going to borrow it to you. Then you sell the silver to the fabricators and pay us back. I think that's going to happen. But the one thing is that it's they can only do that once. So what'll happen if they do that is the price of silver will drop probably 20, 25 bucks in a single day. They won't do it until silver's like 80, 90, $100. But when they do it, you can expect silver to drop about 20 bucks. But the problem is that's a one and done thing. Okay, you got 1 billion, you got 1 billion ounces. Guess who's else is going to buy those 1 billion ounces? Is the investors are going to buy them. Directly or indirectly, somehow they'll get their hands on them. But the investors, their ears are going to perk up because their investors are going to go, oh, now there's no inventory because that was the last of it, right? Once that billion ounces is used up, it's kind of game over situation. Then you're looking at $500 silver. You don't want to sell these gold and silver miners early in the cycle. We're early in the cycle. I'm not selling any stocks until we get to at least $5,000 gold, at least. So wait till $5,000 gold, and then I'll look around and say, okay, is it time? So what I'm waiting for is the market the cycle to at least mature a little bit. We need to at least get to the 4th or 5th inning. And until then, it's not, in my opinion, you can make money when you buy and you can make money when you sell, but you can make a mistake selling. But the other thing is you don't want to not take profits, but you want at a certain point, but you want to at least, get the stock a little bit mature. So I'm not in the camp that, take profits early just because your stock doubled, tripled, I have a stock right now that's a 30 bagger and I haven't taken any profits and I'm not going to take any profits until it's a 65 bagger probably. And so, I'm just, basically I want to take that initial investment. I want 2 or 3 of my stocks to pay off my entire cost basis. That's my plan. And right now I'm on track for that. And so there's no way I could do that if I take profits in them. And so I'm on track right now for 50 10 baggers. And there's no way I'm going to get 50 10 baggers if I take profits.